Hello and welcome back to my 10 favorite people. Hope you're doing well. I'm incredibly excited for today's video because this truly feels like Bitcoin's moment of truth. We've been putting in lower highs and higher lows for the past few weeks now, consolidating between Bitcoin's 20-week moving average as resistance and its 50-week moving average as support. And today's FOMC meeting feels like the perfect catalyst to decide Bitcoin's next direction. And contrary to popular belief, this is not going to depend on whether we see a 25 basis point rate cut or a 50 basis point rate cut. It's going to depend entirely on what the Fed tells us in their economic projections. And the last time we received an economic projections was June 12th of this year. And if we look at what Bitcoin ended up doing, once we saw that last update, we had a sell-off the following few weeks. And if we look at the economic projections before that, which was in about mid-March, we saw Bitcoin put in a local high and sell off the following few weeks then as well. And this was almost entirely driven by the fact that the market was always a lot more optimistic with how many rate cuts we were going to see compared to what the Fed ended up telling us in this quarterly update. And now a lot has happened since our June update. We know the labor market has weakened quite a bit, but the market as of right now is expecting the federal funds rate to be about 4% by the end of 2024, which is significantly below what the Fed told us in June. So we'll see what the Fed ends up releasing today and how close that is to the market's current expectation for the end of the year. But then if we look forward to the end of 2025, the market is expecting 3% for the federal funds rate by even just September. And the Fed told us they were going to keep it about 4.1% in the June projection. So we'll see what they end up saying for 2024 and 2025. And I do believe this is going to have a big impact on the markets, just like the last two economic projections did. And I think it's going to be the deciding factor on whether we're going to get that early breakout everybody's praying for, or if we're going to have that one last major shakeout going into October and November before we can really start this rally in late Q4. I'm prepared for both outcomes, but I'm leaning towards the normal cycle scenario being a little more likely, especially with all the uncertainty we have as we approach November. And so far, the market has been overly optimistic over and over again when it's come to these Fed rate cut expectations, and they usually end up getting disappointed by the economic projections. Whenever the Federal Reserve is more dovish than the market expects, it tends to go down. And when the Federal Reserve is more hawkish, the US dollar index tends to strengthen. And right now we are sitting on major support. So it would make a lot of sense to see a bounce here before rolling over later in the year. And maybe that's what's going to end up aligning with these economic projections and the Fed being a little bit more hawkish than the market has hoped for. So we'll almost immediately see those economic projections reflected in the US dollar index. And this is important to us because we know how strong the inverse correlation is with Bitcoin on larger timeframes. So we really need to see that bounce and aggressive rollover if Bitcoin is going to enter price discovery like everybody is hoping for. And we're going to see an alt season like the one we saw in 2021 and 2017, because we've seen nothing but altcoins struggling over the past 8 to 9 months, while the Fed has kept these interest rates elevated. The other very important factor of today's meeting is whether or not the Fed is going to go back to buying assets and adding to their balance sheet. They've been doing what's called quantitative tightening ever since the beginning of 2022, and you can see that global liquidity has been going down ever since. And quantitative tightening is just when the Fed is selling assets on their balance sheet and taking money from the economy, reducing the money supply. And that's what they've been doing for almost the past 2 years now, just like what we saw in 2019. But now that that yellow line, the Fed balance sheet, is beginning to level off, perhaps we could start seeing it increase once again soon. And that would be something they would announce at today's FOMC meeting. And then quantitative easing would just be them increasing the money supply by buying bonds or other financial assets in circulation and putting money into the economy. And we know that Bitcoin tends to have a very strong correlation with global liquidity, as we've seen historically. When global liquidity is going down, Bitcoin suffers. When global liquidity goes sideways, Bitcoin doesn't do much. But when we see a big impulse in global liquidity, we see those huge rallies from Bitcoin as well. 2022 liquidity was down. 2023 liquidity is sideways to down, but Bitcoin was still able to get back up to its previous all-time high. So we really need to see liquidity go up significantly if we're going to get the rally from Bitcoin that everyone is hoping for. And with the Federal Reserve managing the reserve currency of the world, the US dollar, they have the biggest impact on global liquidity, in my opinion. So this FOMC meeting today, and whether or not they're going to go back to quantitative easing and increasing their balance sheet, should have a huge impact on risk assets and Bitcoin. And we like to be prepared for multiple outcomes on this channel. So whether we see QE soon and break out earlier than the normal cycle scenario, or if the Fed waits until November or December to go back to QE and really kick off the next Bitcoin rally, I like to have the simplest strategy possible, which for me is doing nothing while Bitcoin is trading in what I consider to be a fair value range between 50K and 70K, and consider adding more if we go into the undervalued region, or perhaps taking some profits if we go to the overvalued region. But for now, at 60K Bitcoin, I'm not that excited to add to my positions or reduce my positions, because I consider 50 to 60K to be a fair value range. And so far, the market has agreed. I think this chart was released in about May of this year, maybe around here. And every time Bitcoin has gotten close to 70K, sellers have stepped in. And every time we've gotten close to the high 40s, buyers have stepped in aggressively, and it's ended up with a wick. But I think within the next week or two, Bitcoin is going to pick its next direction based on what the Federal Reserve ends up doing, and we'll have to strategize based on that outcome. So for now, we remain cautious, at least as long as Bitcoin is trading below its range low of 61.5K. Notice how each and every bounce into this range has been getting weaker and weaker. And now Bitcoin is testing that resistance as we get ready for today's FOMC meeting. If we're able to reclaim it, we can start talking about short-term bullishness, but right now it is a rejection at the range low, and looks a lot more likely that Bitcoin is going to roll over here versus actually break back into the range. But we're open to both outcomes. We're also still being conservative because we have about 2 weeks to go in Bitcoin's summer chop seasonality. So far, this summer has played out just like every other summer outside of those mania years of 2021 and 2017. And I'm excited for this to finally be behind us so we can look forward at more optimistic seasonality. October tends to be very, very solid for Bitcoin. And then November usually ends up being a coin flip based on what happens with the election and what happens with the Federal Reserve. But I'm expecting an optimistic October, and then we're really going to have to lock in for November and see what's going to happen with the election, because it has remained close ever since I started monitoring it here on Polymarket. Trump pulls away a little bit and then Harris pulls away a little bit. But as long as they're both between 45 and 55%, there's still going to be a lot of tension and drama as we approach the November deadline, just 48 days away, and a lot can happen in markets during that time. We know that volatility tends to increase as we approach November, especially in elections that are close. And so far, we've been seeing that in the S&P 500's volatility index, also known as the VIX. We bottomed out in about June, and volatility has been going up slowly, and market participants have been expecting more market volatility as we've gotten closer and closer to November. And we're seeing that in the S&P 500's price action. Starting in about early July, we see the aggressive sell-off with everybody panicking over the Japanese yen carry trade. We get a strong bounce close to the previous all-time highs. Everybody starts celebrating, saying it was just a bear trap. Then we sell off again, everybody panics, rally back to all-time highs. Everybody's excited and bullish again. And I think this is only going to increase more and more as we approach November. So because of that election uncertainty and September seasonality, I remain cautious in the short term. But when we look forward to the medium to long term and see these enormous national deficits being run by the federal government, and how we're likely going to surpass a $2 trillion deficit this year, something that's completely unprecedented outside of recessions, with the federal government trying to outspend the recession and keep the economy afloat, while the Fed has been hiking rates. And we know that there's a clear relationship between the US national debt and the S&P 500, and each recession just ends up resulting in more aggressive debt growth because eventually that debt has to get monetized, either because other countries buy it or the Federal Reserve buys it and puts it on their balance sheet. And I don't think this is a good trend. I do think this is going to be a massive issue one day, but I do think most people underestimate how long these things take and how long these things can go on. This is a trend that's been going on for decades now, so I don't feel comfortable predicting that the entire system is going to collapse and fall apart tomorrow, like many of the macro doomers will have you believe, because when we look at this trend of what we've seen with the US government debt and its relationship with the US money supply and how the national debt always leads first and then the money supply catches up as that debt gets monetized, it's hard not to be incredibly optimistic risk assets like Bitcoin when we are going through this fiscal spending regime and this money supply expansion. So I know there's still a lot of people out there panicking over rate cuts, and they're saying that if the Fed cuts by 50 basis points, it's because the economy is collapsing into recession and markets are going to crash. But if we have a 25 basis point rate cut, everything is going to be fine because it's not going to panic the markets. I prefer to zoom out and look at the big picture. Yes, in previous cycles, the Fed cut rates too late and waited until the economy was actually broken. But if we look at what the federal government has been doing with their deficits and the amount of debt issuance we've seen to fund the economy and keep the economy afloat, I have a hard time believing that we're going to see a market crash because the Fed is reducing rates, especially because I think this rate cutting cycle is expedited by the amount of interest being accumulated by the US federal government because the Fed has raised interest rates, and the absolute ballooning we've seen of those interest expenses for the US government. I think that's a huge reason why the Fed is cutting when they are now and not waiting longer like they did in 2007 and 2001 for the economy to enter recession before the rate cuts. Because when I take a look at the unemployment rate, the Fed's preferred measure of employment, I see it still almost 1% below the average recession start. And of course, we'll continue to monitor this as we get more and more data points. But as of right now, we're still well below when recessions have started historically. And that's also confirmed by what we've seen from initial jobless claims. We get an update to this every week, and we're still below our July 2023 high. So we're really not seeing those layoffs happening like you would expect in a recession, with the recession start average being closer to 360,000 jobs. And if we take a look at continuing jobless claims, the number of people filing for unemployment, we're still well below the recession start average there as well. So when we look at the labor market, it doesn't look too bad. Inflation is being a little bit stubborn if we look at the Fed's preferred measure of core PCE, which is still at 2.6%, which is quite a bit above the Fed's target. But if we look forward at trueflation, which is what we like to use as a leading indicator for inflation because it updates daily and because it uses more modern methods, it's showing us just 1.1%, which is a good sign for where inflation is going to go over the next few months. And finally, if we look at growth, now sitting close to 3% for Q2, which is well above the recessionary number of 0. And we know you need 2 negative quarters in a row to be considered a recession. And if we look forward at the Atlanta Fed's GDP Now estimate, still expecting close to 2.5% and still well above the recessionary 0 bound. So whether we look at economic growth, inflation, or the labor market, I don't see any signs screaming towards imminent recession. Maybe it happens 6 to 9 months from now, but as of right now, I think the Fed is cutting rates because of the interest situation the federal government is having to deal with, and not because the labor market is collapsing or because the economy is collapsing and not growing. So we'll wait and see what happens for now. We know that risk assets are driven by liquidity, and the Federal Reserve lowering rates and going back to quantitative easing is definitely more liquidity for markets. And that's why we see the historical correlation between the S&P 500 and Bitcoin. They're both quite driven by liquidity. And when we consider the fact that we now have BlackRock and Fidelity offering Bitcoin products that anybody can buy in their brokerage, and the Fed is getting ready to start increasing liquidity in the system alongside other central banks, and we have BlackRock marketing Bitcoin on their website, and Fidelity marketing Bitcoin on their website, something I could have never believed would happen one day when I joined the space in 2017, it becomes very hard not to be bullish on Bitcoin in the long term. I still think this is all part of one big mid-cycle reaccumulation phase before liquidity comes back in and Bitcoin expands higher. And the best way I have found to manage my emotions and focus on the big picture is by looking at charts like this one and not getting roped into everybody encouraging you to trade with leverage and end up in these liquidations that we see each and every day on exchanges, or go and buy altcoins that are incredibly risky and making venture capitalists rich because they got in at 1/100th or 1/1000th of the valuation you're buying in at once that coin actually becomes available. And if we look at the amount of altcoins unlocking month over month, it's very hard for me to be optimistic in the short term. We're seeing about $1.6 billion worth of unlocks for teams and founders and venture capitalists of altcoins here in September. In October, we're expecting $2.4 billion. And in November, we're expecting another 1.7 billion. And the question we have to ask ourselves is who's going to buy all of these altcoins as they unlock when the founders and venture capitalists go to sell? And that's why I like to try and avoid risky altcoins. I really try to avoid leverage because we can be completely right on our thesis and we can be completely right on Bitcoin's long-term price increases, but then end up losing all of our money anyway by using leverage or going all in altcoins. So anyway, try to be careful with that and try to be careful with what people are selling you, whether it's on Twitter and YouTube, because we do remain bullish risk assets in the long term because fiat currency debasement isn't going anywhere. So if we're bullish the S&P 500 and Bitcoin in the long term because of that debasement, all we have to do is be patient and not get shaken out along the way. But anyway, let me know what you expect from today's FOMC meeting. Is the Fed going to come in more hawkish or more dovish with what they're projecting for the federal funds rate by the end of 2024 and the end of 2025? I think they're going to be more hawkish than the market is currently pricing in. And I think markets won't like that, but we'll definitely wait to see what Powell says and wait to get that updated projections and cover it in the next video. But as always, don't get shaken out by the short term and focus on the long-term picture. Thank you so much for the support on the recent videos. Thank you so much for watching, and I'll talk to you soon.